that we've covered the most basic definition of the RSI, let's dive a little deeper into how it's actually formulated. There are actually two parts to the RSI's calculation. The default setting for the RSI is 14 periods, so it looks back at the last 14 days. Using the average close in the first 7 days and then the subsequent 7, and taking the gain or loss percentage of both 7-day periods. It will look a little bit like this: 100 minus 100 divided by 1 plus average gain divided by average loss. For example, let's say that in the first 7 days, the market closed with an average gain of 2%, and then the next 7 days, it closed with an average loss of negative 0.9%. If we were to calculate that, this would be the result. RSI equals 100 minus 100 divided by 1 plus 2.22. In this example, the RSI would read 68.9, and that would place the line segment just below the overbought threshold of 70. Then comes the current 14-day data that compares the two results. When these two calculations are combined, the result is a smoother, more accurate RSI reading. This one compares the previous gains and losses to the current ones, and it is calculated like so. RSI step 2 equals 100 minus 100 divided by previous average gain multiplied by 13 plus the current gain, which is divided by previous average losses multiplied by 13 plus the current loss. Now that you know how the RSI is calculated, how do you implement this information into a strategy? First, it's important to define the range the RSI is analyzing and whether it breaks thresholds, which indicate either a bullish or bearish trend. If you're in a bullish market, the number you should be looking at signals hovering around 66.66. In bearish markets, you need to look for a reading of 33.33. In this example where the market is oversold and the RSI dips to around 33.33, you can see that a new bullish trend is occurring. This means that long positions would have carried your trades for the entirety of the bullish run. How can you time this though? Well, there are a few strategies you can implement with the RSI. If you want more information on screen, the RSI plus MACD is a good strategy to observe. The MACD helps you identify convergence and divergence signals, which can pinpoint your entries if the readings match the RSI's. Using the MACD and RSI together can also give you exit signals. In this example, we see our buy signal when both the MACD and RSI show the same dip. Then, as it starts to rise and both indicators reach threshold, we exit the trade. You could also just follow price action and candlestick analysis for trading signals. This requires you hold on to the trade until a proper confirmation of the move from both price action and the RSI. Once you see a big candle followed by candles with big wicks and small bodies, that indicates a change in the trend. Follow this right, and you can catch on to the new trends before they hit and ensure your trades have the maximum potential for profitability. Thank you for watching. Make sure to like this video, leave us a comment, and subscribe to our channel for more videos. If you want to get notified of our next upload, click the bell button. We'll see you again soon.